होगी सेव चलो
Good morning, everyone. Today, I Tanish belong to Punjab, and I would like to present my presentation on the topic basics to accounting. So let's start without any ado. Basics to accounting. So first basic is journal, meaning journal is a book of original entry in which business transactions are recorded date-wise and serial-wise. It is also known as day book or primary book. It is known as day book because every day-to-day transactions are recorded in it, and primary book because it is the first book in which the transactions are recorded. Structure. It has a date column, particulars column, ledger folio column, debit and credit column for the recording of the so date column states that it is a column for containing the date for recording the date on which the transaction has occurred. Particulars column shows the accounts which are involved and gives a narration for the transaction for the layman. Ledger folio records the page number on which the specified accounts are maintained in ledger, while debit and credit column are used for recording of the amount in either debit or credit side. So, uses journal has the following uses. First, it is a primary book for recording of transactions. Second, it records every transaction in chronological order. And third, it uses double entry system for recording the transactions. However, journal is also known as the book of original entry. Next is examples of journal entry. First, started business with cash rupees 10,000. So the entry would be here the date April 1st, particulars cash account debit to capital account, and here's the narration being started business with cash. Ledger folio is empty for the time being, and debit 10,000 and credit 10,000. The next example is purchase goods on credit 4,000. Purchases account the narration is being goods purchased on credit. The next entry is purchase goods 6,000 half amount paid in cash. So April 3rd, purchases account debit 6,000 to creditors account to cash account 3,000 and 3,000. So narration would be being goods purchased and half amount paid in cash. The next is trade discount and cash discount, meaning discount is the deduction or reduction in the price paid or received amount from purchase price. The first discount offered by the shopkeepers or the sellers are trade discount. Trade discount is a discount given for the bulk purchase of goods on the list price and is given to every person either buying goods on cash or credit. It is not recorded in the books because it is given to each and every person. And the main motive of this discount is the sales promotion of the goods. Cash discount. Cash discount is a discount given on the instant cash payment and is only instant cash or pay the cash in a fixed period of time. It is not recorded in the books because it is not given to each and every person. And the main motive of the to give the cash discount is is to receive immediate cash. So here are some examples of discount. Goods purchased 20,000 on 10% trade discount. So the entry would be purchases account debit to creditors account 18,000 and 18,000. So as we said, the trade discounts are the discounts which are not shown in the books of accounts. So 10% is deducted from the goods purchased and then it is shown in the books. So therefore 10%, 20,000 or 10% of 20,000 is 2,000, which after deduction the total amount recorded in the book will be 18,000. So the narration would be being goods purchased on credit and on 10% trade discount. The next is goods purchased 30,000 for cash on 5% rate discount and 3% cash discount. So the entry would be purchases account debit. So after deduction of trade discount, the total amount remaining would be 28,500. So to cash account 27,645. Here the full amount of cash was paid, so the discount is given on full amount. And after the receiving of discount amounts to 855. So the remaining cash, so the remaining amount is paid. So that the remaining amount is 27,645, and to discount received, which is the discount which is given by the seller, that is 855. So the narration would be being goods bought on 5% trade discount and 3% cash discount. Then last entry would be goods sold goods sold 50,000 on 10% rate discount, 2% cash discount, and half payment is received. So for instance, for this entry, here is the debtors account debit 22,500, because half of the amount is remaining to be received. The next is cash account debit to 22,050. Here, the amount is recorded as 22,050 because 2% of cash discount is allowed only on the cash paid, that is 22,500. And after allowing the discount amounts to 450, and the cash paid by the debtor is 22,050. So the last is to sales account, that is 45,000, or the total sales made. So the narration would be being goods sold on 10% trade discount and 2% cash discount, and half amount is received in cash. So next is drawings. Meaning, drawings is the amount withdrawn from the business by the proprietor for his personal use. The withdrawn amount can be in the form of cash, goods, and money with the bank. In this case, proprietor is assumed as the receiver. Different words that represent drawings are personal use, domestic use, private use, income tax, household use, and life insurance premium. So examples of drawings are withdrawn 3,000 cash and 4,000 from bank for personal use. The entry would be drawings account debit to cash account to bank account. So the total amount of cash and bank are drawings. So the total amount, that is 7,000, is debited to drawings, and the leftover amount are to trans leftover amount are recorded in cash account and bank account. That is 3,000 and 4,000. So the narration would be being withdrew cash and from bank for private use or personal use. Next is withdrawn goods of 2,000 for private use. Here the case is of goods, not the cash from bank or the cash from the cash drawer. So the entry would be drawings account debit to purchases account. Here the purchases account is credited because the goods in the real account are going. So therefore purchases account. But the main thing is that the goods are recorded, for the purpose of drawings, goods are recorded on the cost price, not on the sales price. Therefore to purchases account, that is 2,000. The next and the last entry is paid 6,000 life insurance premium and 4,000 income tax. So life insurance premium and income tax, both are the drawings, are taken as drawings. So the entry would be drawings account debit 10,000 to cash account. The amount 10,000 is the sum of 6,000 and 4,000. So the entry is like, so the narration is like being life insurance premium and income tax paid. The next thing is interest on capital and drawings. Meaning, interest on capital is the interest which the business has to pay back to the proprietor. It is just charged to check the capability of business to pay back the debts. Similarly, if the interest on capital is charged, then for the balance of the situation, interest on drawings is also charged. However, they both don't make any difference to the value of the business. The examples are 6% interest on capital of 2 lakh is charged. So here interest on capital account debit to capital account. The amount would be 12,000 as the 6% of 2 lakh. The next entry is 8% interest on drawings of 30,000 is charged for 1 month. Here, the drawings is not charged for the whole year, but for just 1 month. So, the entry would be drawings account debit to interest on drawings account 200. This is because 8% of 30,000 is further divided by 12 because it is charged for just 1 month. So therefore the amount which is recorded is 200. The next entry is 10% interest on capital amounting to 6 lakh is charged for 2 months. Here the consideration is of 2 months rather than 1 month. So let's see. The entry would be interest on capital account debit to capital account 10,000. Uh, Here first the amount is first the amount first the 10% of amount is calculated, that is 60,000, and then it is divided by 12 and then multiplied by 2, which gives you the total amount of 10,000. So therefore, interest on capital account debit 10,000 to capital account 10,000. So narration would be being 10% interest charged on capital for 2 months. So the next thing to be studied about is depreciation. Meaning, depreciation is the cost of machinery or furniture used up in certain time period. This is the this is the reduced from the cost of asset or fixed asset which is depreciated. There are different ways of calculating depreciation: original cost method or straight line method, written down value method, or diminishing balance method. The method which is preferred by the income tax authorities is written down method. So examples of depreciation. The machinery was costing 20,000. The machinery costing 20,000 is depreciated at the rate of 5% per annum. The entry is depreciation account debit to machinery account, and the rate, the amount to be debited or and credited is 1,000. The narration would be being 5% per annum depreciation is charged on machinery costing rupees 20,000. So next example is the furniture is depreciated 3,000. Here the amount of depreciation is given directly, while in the above transaction the amount we have to look out for. So the transactions will be recorded as depreciation account debit 3,000 to furniture account 3,000. So the narration would be being depreciation is charged on furniture. So the last thing to be studied is opening entry. Opening entry is the first entry of the accounting year if the business has not been started before that year. If the business had been started before that year, the stock left with the business last year or the closing stock becomes the opening stock of the current financial year. The entry is made on the basis of accounting equation, that is assets equal liabilities plus capital, where all the assets are debited and liability and capital are credited. The example of opening entry. Here the first example is where the capital account is not given. So the entry transaction would be cash account debit, bank account debit, stock account debit, sundry debtors account debit to sundry debtors account debit to sundry creditors to loan account. Here, after summing up this amount and after summing up of these amount, the amounts are unequal. So the amount here is shorter than. So the amount in the credit side is less. So therefore, when the amount is deducted from assets, so and the resulting amount is 2,001 lakh, which is capital. So that is the balancing figure. So the transaction would be being opening entry brought forward. Thanks for your collaboration. I hope you liked the presentation.